This week, the Federal Reserve is set to add nearly $10 billion into the American banking system. This action is part of what is called a repurchase agreement, often shortened to repo. It is a tool the Federal Reserve uses often, though most people never hear about it in daily news. Gold and Crest Finance brings this story to viewers because it touches something everyone deals with: money, prices, and the value of savings. So what exactly is happening? A repurchase agreement is a short-term loan. Banks and large financial dealers give the Federal Reserve valuable assets, such as government bonds, as a kind of guarantee. In exchange, they receive cash right away. Later, usually within a day or a few weeks, they buy back those same assets, paying a small extra amount as interest. This process helps banks get quick access to money without selling their assets completely. This is not a rare event. The Federal Reserve has used repurchase agreements for many years. However, this specific operation, worth close to $10 billion, has caught attention because of its size and its timing. Officials say this is a normal step. They explain it helps keep the banking system stable. When banks need extra cash for a short time, this tool allows them to get it quickly. It is meant to stop sudden problems, like a shortage of cash, from spreading through the financial system. The Federal Reserve has used similar tools during past periods of stress. One notable example happened back in 2019. At that time, a much larger amount, around $750 billion, was injected using this same method. That moment surprised many financial experts, since such large operations are usually reserved for serious situations. Now, in 2026, a smaller version of this tool is being used again. The stated goal remains the same: keeping the financial system running smoothly, avoiding sudden spikes in short-term interest rates, and giving banks steady access to cash when needed. For everyday viewers, this might sound complicated, but the basic idea is simple. Banks sometimes need quick cash. The Federal Reserve provides that cash for a short time, using government bonds as security. Then the banks pay it back, with a small fee added. Why does this matter to ordinary people? Because these operations affect how much money flows through the economy. When more money enters the system, it can influence prices, interest rates, and even the value of investments like gold and silver. Gold and Crest Finance follows these events closely because financial decisions made in Washington often have a direct impact on regular households. A change in interest rates, a shift in bank behavior, or new money entering the system can all shape how much things cost and how savings grow or shrink over time. This particular repo operation is scheduled to unfold over the coming days. Financial institutions across the country will take part in it. The process itself is quiet and technical, often unnoticed by the public, yet its effects can ripple outward, touching interest rates, lending, and investor confidence. As this story continues, Gold and Crest Finance will explain what rules govern these operations, what officials are currently saying, and how this event may shape the coming months. Viewers who care about savings, retirement, or investments in gold and silver will want to understand exactly how these behind-the-scenes financial tools work. For now, the key takeaway is this: nearly $10 billion is entering the banking system through a well-known but rarely discussed process. It is described as routine, yet its size, timing, and history make it a story worth watching closely. To understand this week's operation, it helps to know the rules that guide it. Repurchase agreements are not random. They follow a clear structure set by the Federal Reserve, and they are watched closely by financial regulators across the country. At the center of this system sits the Federal Reserve Bank of New York. This branch handles most of the day-to-day work involved in repurchase agreements. It manages the auctions, sets the terms, and works directly with major banks and financial dealers who take part in these operations. Here is how the process works in practice. A bank or dealer offers collateral to the Federal Reserve. This collateral usually comes in the form of government-backed assets, such as Treasury securities or mortgage-related bonds. These are considered safe and reliable, which is why they qualify for this kind of exchange. In return, the bank receives cash immediately. The agreement includes a set date when the bank must buy back its collateral. Most of these deals are settled overnight, meaning the exchange completes within a single business day. Some arrangements stretch longer, lasting several days or even weeks, depending on what the market needs at the time. The cost of this exchange comes in the form of interest, known as the repo rate. This rate tends to sit below the Federal Reserve's official interest rate. Because of this, banks see it as an affordable way to access cash quickly, without having to sell their assets outright. Regulators require lenders to apply what is called a haircut to the collateral. This means the value of the assets offered is slightly reduced to protect against sudden price changes. If the market shifts and the collateral loses value, this cushion helps prevent losses for the party providing the cash. There's also a mirror version of this process, known as a reverse repurchase agreement. In this version, the Federal Reserve sells securities to a bank, agreeing to buy them back later. This tool helps remove extra cash from the system when there is too much liquidity floating around. Both tools used together help the Federal Reserve manage the flow of money in the economy. Officials describe these operations as part of standard financial housekeeping. They explain that keeping enough cash available prevents sudden jumps in short-term interest rates. Without these tools, banks might struggle to meet daily cash needs, which could create stress across the wider financial system. As for the current situation, sources close to the Federal Reserve confirm that this operation, worth close to $10 billion, is designed to support smooth banking activity in the coming days. Officials have stated that this is not a new stimulus program. Instead, they describe it as part of ongoing efforts to manage reserves and maintain stability. Market analysts have pointed to the M2 money supply, a measure of the total money circulating in the economy, as an important detail to watch. Recent data shows this figure climbing steadily, with a brief slowdown around early 2023 before resuming its upward path. The next official update on this measure is expected by the end of July, and many analysts are watching closely to see how this new liquidity affects the overall trend. Crest Finance notes that transparency around these operations remains limited. While the Federal Reserve publishes general information about repurchase agreements, the finer details, such as which specific banks take part, are rarely made public. This adds to public curiosity, especially among viewers who want a clearer picture of how monetary policy decisions affect their daily lives. As the coming days unfold, more information is expected from financial institutions and regulatory bodies. Crest Finance will continue tracking developments, bringing viewers verified updates as the situation becomes clearer. Every financial decision carries ripple effects, and this liquidity operation is no exception. While the Federal Reserve frames it as routine, the broader consequences touch inflation, interest rates, and household budgets across the country. The most immediate concern among economists centers on inflation. When more money enters the banking system, it tends to circulate more freely. Banks lend more easily, businesses borrow more comfortably, and spending often increases. Over time, this greater flow of money can push prices higher, since more dollars begin chasing the same amount of goods and services. Analysts tracking the M2 money supply, which measures the total money circulating in the economy, point to this figure as a key signal. It has been climbing steadily, and additional liquidity operations like this one may add to that upward trend. This connects directly to interest rates. If inflation continues rising, the Federal Reserve may respond by raising interest rates rather than lowering them. Higher interest rates affect nearly everyone. Mortgages become more expensive. Car loans cost more. Credit card balances grow faster. Businesses also feel this pressure, since borrowing money to expand or hire new workers becomes costlier. For families managing tight budgets, even a small rate increase can make a noticeable difference in monthly expenses. Gold and silver markets also feel these effects, though not always in obvious ways. Many people assume that when the Federal Reserve adds money to the system, precious metals prices should rise immediately. However, the relationship is more complex. In the short term, if higher interest rates follow this liquidity operation, gold and silver prices may actually soften, since higher rates often make interest-bearing investments more attractive compared to metals that generate no interest income. Over a longer period, the picture shifts. Analysts note that continued increases in the money supply can gradually erode the purchasing power of the dollar. As this happens, many investors turn to gold and silver as a way to protect their savings, since these metals are not tied to any single currency or government policy. This is why some financial experts describe gold and silver as long-term stores of value, even when short-term price movements appear unclear. Beyond markets, this story also raises broader questions about financial stability. Some economists argue that frequent use of repurchase agreements shows that parts of the banking system rely on regular support to function smoothly. They suggest this reliance could point to underlying pressures within the financial system that deserve closer attention. Others take a different view, arguing that these operations are simply modern tools for managing a large and complex economy, no different from routine maintenance in any major system. Both perspectives deserve consideration. Supporters of these operations emphasize that they prevent sudden shocks, such as sharp spikes in short-term borrowing costs, which could otherwise disrupt everyday banking activity. Critics counter that repeated liquidity injections may mask deeper structural issues, allowing problems to build quietly over time rather than being addressed directly. For everyday households, the consequences extend beyond financial headlines. Rising prices affect grocery bills, housing costs, and everyday essentials. Interest rate changes influence how much people pay on loans and how much they earn on savings accounts. Even retirement planning can be affected, since investment portfolios often include a mix of stocks, bonds, and sometimes precious metals, all of which respond differently to these economic shifts. Crest Finance emphasizes that no single explanation fully captures how these consequences will unfold. Economic outcomes depend on many factors working together, including future Federal Reserve decisions, global events, and consumer behavior. What remains clear is that this liquidity operation, though described as routine, carries effects that extend well beyond the banking system itself. touching the daily lives of people across the country. As this story continues to develop, several questions remain worth considering. Viewers may want to ask themselves how these financial decisions could affect their own households in the months ahead. Will rising prices change the way families budget for everyday expenses? Will interest rate decisions influence plans to buy a home, finance a car, or manage existing debt? These are personal questions, and the answers will differ from household to household. But staying informed helps people make better decisions with the information available. Looking ahead, several developments deserve attention. The Federal Reserve's next policy meeting will offer more clues about the direction of interest rates. Analysts widely expect officials to weigh incoming inflation data carefully before making further moves. The M2 money supply report, expected by the end of July, will also provide fresh insight into how quickly money is circulating through the economy. Many economists consider this figure an important signal for understanding inflation trends in the months to come. Financial institutions will continue monitoring how banks respond to this liquidity operation. If similar repurchase agreements become more frequent or grow larger in size, some analysts suggest this could indicate ongoing pressure within the banking system. Others maintain that occasional operations of this kind are simply part of normal financial management, especially in a large and complex economy like that of the United States. For those following gold and silver markets, upcoming months may bring more clarity. Analysts note that while short-term price movements can be unpredictable, long-term trends often reflect broader shifts in currency value and inflation. Viewers interested in these markets may find it helpful to follow updates from established financial sources, along with official releases from the Federal Reserve and the U.S. Treasury. Golden Crest Finance encourages viewers to stay engaged with trusted financial news throughout this period. Reliable information helps people separate routine developments from those that carry more significant consequences. Following credible sources, reviewing official statements, and comparing multiple viewpoints all support better informed decisions, whether related to savings, investments, or everyday financial planning. Viewers are also encouraged to share their own perspectives. Do these liquidity operations feel like ordinary financial housekeeping, or do they raise deeper concerns about the health of the broader system? Are there differences in how these events are felt across different regions or communities within the country? Reflecting on these questions can help deepen understanding of how national financial policy connects to daily life. As with many economic stories, patience remains important. Effects from monetary policy decisions often take time to fully appear. What seems minor today may carry more weight months or even years down the line. Golden Crest Finance will continue following this story, along with related developments in banking, interest rates, and precious metals markets, bringing viewers updates as new information becomes available. This story is a reminder that financial decisions made quietly within banking systems can shape outcomes far beyond Wall Street. From grocery bills to loan payments, from retirement savings to long-term investments, these developments touch communities across the country in ways both visible and unseen. Golden Crest Finance. Thanks, viewers, for taking the time to follow this important story. Understanding these financial mechanisms, even when they seem technical or distant, empowers people to make thoughtful decisions about their own financial futures. Staying informed remains one of the most valuable steps anyone can take during periods of economic change. This has been Golden Crest Finance. Stay informed, stay prepared, and thank you for watching.